$2.50. Yeah, so you can buy 2 ticks below limit down with the synthetic options that are on the screen right now.
Yeah, and that tells you where the market thinks we're going to be tomorrow.
Yeah. Yes, it does. Oh, I gotta. Oh, whoa! I'm ready to share your screen when you are.
It's shared, yeah. Whenever you're ready.
Oh no, but it's not the screen that you want shared.
Oh, I got you. Okay, hang on 1 second here. Let's see. Let's try it now. Let's see. Oh, I'm sorry. Let's see. Share. We put this in slideshow from the beginning. There you go.
All right, people are coming in. I like the orange sweatshirt.
It's my one of my ski sweatshirts underneath my skiing shells. We actually have winter time in Cleveland where we've probably got a good, I would say at least a good 2 feet of snow on the ground right now.
Really?
Yeah, we've gotten a lot of lake effect, a lot of snow, cold weather. So it actually looks and feels like winter outside for a change.
It's felt like winter here in Chicago this morning. My one of our cars is in the shop. A deer ran into the side of my car, so I unfortunately had to take the train to work this morning.
Yeah, no, I've been there, done that with deer. Good times.
Oh, for sure.
At least it didn't come through the windshield. So
No, we were fortunate on that part. All right, let's kick this off. Hello, everyone. It is Lumber Futures from the Free Seats. We've got a lot to talk about today, and we got Greg Kuda with Westline Capital, of course.
hello,
Mike Wisniewski
everybody.
with Materials Exchange, and let's get this kicked off. We're gonna.
So, what a tumultuous week to say the least in lumber futures. The tale of two cities, one extreme to the other, where we've had a complete collapse, sell-off in futures. We talked about this the last couple of weeks that when this market was ready to top out, it would be less a function of actual price, more a function of timing, and predicting that timing was going to be a thankless job. And boy, was it ever. I'd like to say that I have all these smart things to say as why lumber, all these red flags that were there a week ago, why we topped out. It's easy to look back. Hindsight's always 2020. Obviously, it's easy to trade the left side of the chart. So, the only thing that jumps out, and I showed this chart last week, lumber is the orange line. When you look at equities, the black line is the S&P, the green line is the Dow, the blue line is the NASDAQ. The only obvious correlation week over week here is a continued pounding of equities where somehow, if I'm going to make an attempt at a correlation, lumber attached itself to the threat of inflation, higher interest rates, and for whatever reason, the longs got spooked out or are getting spooked out. And the only thing that's obvious when you look at lumber versus other commodities, you really have this detachment. Lumber seems to be correlating over the last couple of weeks to equities more than anything else.
Yeah, it's absolute risk off trade, right?
Yeah.
Everybody just get out of everything, get into cash. Which, why would you want to be in cash right now? Well, interest rates potentially going higher, so maybe that's why you want to start moving to cash. But the reality is, it's profit taking. If you could have taken a profit,
Yeah.
But yeah, there's definitely some risk off. When we say risk off, that means get on the sidelines and kind of catch your breath and take a look at the landscape.
Yeah, and I'll jump forward. Here's the daily continuation chart. So basically, last a little over a week ago, we had Jan expiration at 12:37. You can see, with very limited trading today, we're lock limit, we're 1050, 370. There's this massive pull in March. There's a big pull in May. So much so that May's only traded via the spread. May has not traded outright so far today. What does this mean as far as where we've come from? If you take this low, this is about a 972 low back in December. And this Fibonacci's reversed. I apologize. You're well through 62% here. So the next objective to the downside would be somewhere in this 1,000 to 972 area. Underneath there, if you take the November expiration low, then your 50% is going to put you back in that 950, 62% is going to put you back in that 8.25, 850 area. So these are the potential down, big support areas that lie underneath in this market. This is the one thing I want to put into perspective here, Mike. This is bar chart. These are just to look at assets or commodities. This is the last 5 days. You can see that lumber is tracking with the Nasdaq, with the Russell, with the S&P, with the risk off. I mean, here's your risk off. Look at these are the leading assets over the last 5 days. They're all equity based, Bitcoin based, cryptocurrency based, and then lowly lumber. Somehow, this is the risk off with lumber. You flip to, this is the 6-month return. So to put this into perspective, and I'll go back to this, look at lumber. Okay, over the last 5 days, lumber's down 17+%. Over the last 6 months, it's still up 51%. It's still your leading commodity. And you look at all these leading commodities, they're all asset-based, hard physical commodities, inflationary type commodities, where lumber is still up 51% over the last 6 months. So I know it's been a very sudden collapse over the last 5 days, but to put this into perspective, we've come a long way, and you're giving some of that back right now.
Yeah, let's. Do you have the stats that we always look at? Let's take a look at open interest. Let's take a look at that
Yeah, and
commitment
we'll
of
we'll,
traders
we'll come
report.
we'll come back to these. So here's your how quickly the basis changed. Here's futures versus um, Western SPF 2x4s, where futures was at this big premium, and that premium just got annihilated over the last 6 days or so with these limit down moves. So if everybody remembers, we talked about how unusual it was for futures to have the premium, upwards of 100, 150, $170 relative to cash. Well, you've had an absolute 180-degree reversal here, where you went from that 100, 150 over physical cash as of this morning, based upon print at 1225. You're $171 discount now in the front month. And so here's March daily. We'll go look at the basis. The basis a week ago, March was still trading at a premium to cash. A week ago, March was 1278, just starting to top out. You fast forward today, and now all of a sudden print is still in that 1220, 1225 area. March is limit down to 1050, 370. So again, you went from an $87 premium in futures to a $171 discount, basically in 6 days of trading, which is just insane.
Yeah, if you and how this is going to play out is that if you had a hedged inventory, or let's say there was an inventory that was hedged, that hedger is now going to want to sell that inventory as quickly as possible and lift their hedge.
Yeah. No, this is a great opportunity for basis traders to unwind. Again, if you can lift the physical cash, if it's actually in your yard and it's not stuck somewhere on the CN rail system out in the middle of nowhere. So here's May, and again, a week ago, May was trading at a $22. This cash price. Let me see here if this is right. $22. May was trading at a $22 discount. Now it's up to $272, which is just insane. So you went from a basis opportunity a week, 2 weeks ago to a forward price opportunity. So anybody that's got a plan for their spring needs and you have sawmills in this 1200, 1225 plus area, well, now's the time to start. You might not believe in these numbers, but why would you pay 1220 when you can pay 1053 in March? You can pay 952 in May today. You can pay 864 in July. You could conceivably pay this 825 to 850 in September. So you went from a basis trader's dream market to back to this forward type structure where futures is leading the charge to the downside, and now you've got these big discounts. And this is the one that July. Again, I might not like the absolute price here of July at 864, but you're substantially under. You're $360 under physical cash today. At the very least, I start to look at these, especially if I've booked the business and I can lock in my profit margin. So again, you flipped from the basis side of the equation to the forward side of the equation in one fell swoop here.
And that what you said is really important. The difference between a forward price market and a basis trade market. The forward price market, from a time horizon standpoint, if you want to cover your needs for April today, it would be foolish to do it using the cash market of today. You're better off using the futures market. Now, if it's a basis trade opportunity, we talked about getting out of the basis trade, you would put that basis. 2 weeks ago, ideally, you would have put that basis trade on, right? And then you would have waited, and you thought your time horizon would have been probably 6 weeks or so, but it happened in 2 weeks. I guess what I'm getting here is understanding that time horizons can be very different depending on if you're in a basis trade opportunity or a forward price opportunity.
Yeah, absolutely, absolutely. And let's not kid ourselves to say, I'll be the first to raise my, to see this coming. We saw signs. We knew how this would play out. It was the timing of it and the severity of this to happen as quickly. Now, I'll be the first. I didn't see this playing out this dramatically, this quickly, but that's the nature of the beast here. And you kind of put one hat away and put on the other hat. And for those that can forward price and still have to buy their spring needs, at least now futures is presenting a buy opportunity at a substantial discount to current cash prices. And here's the spread. I think the big thing, and I'm going to jump forward here, Mike, and go back to we'll come back to the open interest here. But we looked at this chart for the first time last week. This is rail car velocity. This is car, moving on the CN miles per day. I think last week this was around 144, so it's gradually increasing. You look at, okay, it's it's basically the end of January. You've got another month, depending on when your spring season kicks off. Guys probably have coverage now through February, middle of February, maybe the end of February, slightly beyond, depending on how consumption plays out from here. But the reality is the big guys out there, the big national type buyers probably still have to buy their spring needs and probably are having a very difficult time in accumulating inventory. So, the hope is futures as a leading indicator. It's going to drag cash down. You're going to play this game of chicken with the sawmills. Who's going to have to blink first? The hope is that this rail car situation rectifies itself and there's all this excess wood that has to be shipped at the sawmill level. It offers the market down, but that's the hope strategy versus the reality of, okay, the reality is right now, if I want to buy a Western SPF sawmill, unless you're in Canada and you have your own trucks and you can go buy it prompt, the idea of getting a quick loading prompt car out of Western SPF mills, the reality is you're talking middle of February to end of February. Maybe that increases if this rail time situation improves. Maybe it doesn't, because, you look at the last 2 years from a weather standpoint, the real issues still are ahead of us over the last 2 years. So it's a big if on how this improves. The next chart shows, okay, you're improving. The orange line is 2022. So this is rail cars coming out of Canada, being moved around in Canada. So you're improving, But you can see over the last 2 years that you still had inefficiencies ahead of us before you had this ultimate improvement. So, when do you need the wood? How quickly do you need that order file? And, again, we'd all like to say that we'd magically like to buy this price, sell this price. I still think this is a huge function of timing, and you have to look at your own yard, your own facility, and know, when do I need the wood? When is wood likely going to start to churn out? And you buy the cheapest wood out there. The cheapest wood out there right now is futures. Again, I might not like the price. I might think that it has to go lower, severely lower, but your job is to plan ahead, and not planning ahead, continuously gets this industry in trouble as far as anticipating what their own needs are.
Right. And one of the things that's, I can say pretty confidently, that's not going away is volatility. And
No,
volatility
no,
is the
no.
change of prices. So we're in the midst of a massive volatility move right now. Um, and it's probably going to be sticking around. So I think word to the wise there is, yeah, be cautious. You have business on the books. It might not be a bad call to start covering that business. But all
Yeah,
right,
and again, you might not want to buy futures. You can look at selling puts. You can look at buying calls. You can look at, the inverse of the strategy I'd recommended about a month ago was buying a put, selling a call. You can do the opposite now, where you could conceivably sell a put and buy a call to finance it, or you can just buy calls. But this is when markets have these severe kind of corrections, this at very least should get the average person thinking, what lies ahead for me? Is there something I can do to take advantage of? So far you have almost a 250 to $270 correction in futures without any significant change in the physical cash market. There are rumblings that cash is going quiet, but I have yet to see any big counters from the secondary markets, from sawmills trying to dump. And the other thing I'll point out is that Western SPF is still the cheapest species out there. I know Southern Yellow Pine is topping out or showing signs of toppiness, but when you look at Western SPF 2x4s versus the other species out there, this is still the cheapest wood out there, and futures is the cheapest. This is still the cheapest wood out there. I'm going to go back, Mike, to, I'm sorry, no, I'm going to go forward. Here's open interest. And this is what makes what's taken place over the last week so perplexing, is that you look at open interest a week ago, the board settled 1308.70 in March. Open interest is 2481. This is basically January expiration. January went off at 1237.10. Fast forward to yesterday. Okay, March finished limit down at 1098.70. So you had this massive correction in futures. Look at the total open interest, 2459. So again, 2481 a week ago, 2459 as of yesterday. There's nothing obvious about open interest to suggest, it'd be a lot easier if open interest a week ago was 2481 and today it was 2000 or 1800, where, yeah, it's obvious there was this big fund long liquidation. You had this massive liquidation of longs. They got out of the way. It's reflected in open interest. But the reality is, you've fallen $250 and you really haven't had any type of significant change in the open interest structure, which just, so the reality is, and I'll jump to the CFTC numbers here. The reality is you're going to have to wait until Friday's release just to get an indication what the composition of traders is doing, where, if this is a week ago managed money, this is the most recent report. So you can see as of the 18th, managed money was still getting long. Producers were getting long and short, net short. And then you look at the small guys, they were in liquidation mode. So this is still a large number here. My guess is when you look at this ongoing liquidation, it's got to be fund related. I would think it's got to be non-reportable long related. And why aren't we seeing a big change in the open interest? Are they being replaced by new shorts? Are they being replaced by new longs? With these limit down moves, there's obviously more sellers than buyers. So the reality is, not only is somebody trying to liquidate a long position, they're probably trying to initiate a short position. We're not going to get clarity on this until Friday, until you see the next release of the CFTC numbers.
Right. And, I want to tout some of the facts that you and I have been putting out there. We've been talking about this CFTC report and how important it is to understand what categories are holding what positions. What we know by just looking at the volume that's been traded over the last, limit down days, probably 4 days, 5 days. Not all of
Day number 6, yeah.
basic, not all of the, given the volume traded, not all of the funds could have liquidated.
No, no.
So they're not done yet. And you can probably see it in like you said, the change in open interest. If the funds would have liquidated, they would have been down.
Yeah, and the other thing I'll point out is that this commercial short position, this is typically your sawmills, large basis traders. This position was substantially less than a year ago when we peaked out. So you had significantly less commercial shorts. So in a falling market structure, you just have less shorts to short cover to absorb the market. So unfortunately, it just breeds the illiquidity we're seeing here the last 2, 3, 4 days now, where you've got the longs trapped in margin call hell. And outside of options and being one of the lucky few to get into the pool first thing in the morning, you've got the long side still trapped without, the meat of new buying or short covering that's needed to sop this market up. But again, the thing that, you just look at this total open interest, to see this kind of move and to really see no fluctuation in the open interest. That's unique to me. I don't have a good explanation for that.
Yeah. Time will tell when
Yeah,
this thing
yeah.
finally breaks free. Then we'll know. You know what I want to do right now is I fielded a call earlier, and the call was asking what's the implied price right now in options. Um, so let's make this an education opportunity. I'm going to share my screen and just show you the.
You want me to unshare mine, Mike?
I can do that for you. Oh, okay. And let's make this big. How do I make that big? Oops. Well, it's going to be kind of hard to see. You're going to have to look rather closely. Unfortunately, I don't know how to make it any bigger than this. So there is what's called a synthetic position that you can go into in options. A synthetic position means, so what I'm going to show you here is how you could get synthetically long. And the way you do that is you buy a call and you sell a put at the same strike price. So what we're looking at here specifically, this is the live market for March options on March lumber futures. We're going to look at the 1100 strike. You could buy a call, an $1,100 call, for $43.50. You can sell a 1100 put for $136.70. So what that essentially would do is if the market was to move above 1100, let's say at expiration, you move above 1100, you would exercise your call and you would be long. If the market goes below 1100 at expiration, whoever bought that put from you would exercise it and it would create a long position for you. So what you can see is by buying a put, selling a call, it just gives you a long position in futures. Now, at what price? So what you simply need to do is you take the price that you pay for the call, which is $43.50, and you subtract from that the amount of premium you're taking in on the put, which is $136.70. That gives you a price differential of $93.20. So into your account goes $93.20.
And just to clarify, you're buying the call, selling the put.
Correct. Buy the
Yeah,
call,
yeah,
sell the
yeah.
put. You net out $93.20. So that makes your effective long position the 1100 strike minus that $93.20. So currently, you could actually get long at
1,680.
$1,006.80. So you could actually buy March futures right now below where the limit price is tomorrow.
And just so everybody understands, that's your risk. I mean, anything under 1,680, your risk is dollar for dollar, but that's the net effect of the trade. You're gonna, collect that money, and ideally, if it goes back above 1,100, then you're just long dollar for dollar at that point.
Correct. So if let's just say you looked at the market and you're like, I really want to buy one. Should you go buy, something from that pool that's limit down in March? I would say absolutely not. And the first thing you could look at is buy the call, buy the 1100 call, sell the 1100 put. It would give you an effective long position of $1,006.80.
Yeah, no, I think that's a good strategy. And that's also a way to kind of neutralize a position. You're going to pay a premium to do it, but that's also another way to neutralize. If you're stuck in the pool and you can't get out, you can look at option strategies to neutralize a position with the synthetic option position against that futures position as well.
Right.
Mike, if
So,
we have time, I updated. I'm going to share my screen again here. I updated that option position we talked about. It was that put call spread.
oh, okay. Yeah.
Let me, so back on 12/28, we talked about buying a March 950 put, selling a March 1250 call. It was a credit spread, meaning we were going to buy a put at $43.20. Against it, we were going to sell a lumber 1250 call at 70.10. So we were going to collect $26.90. Our risk was March trading greater than 1276.90. Obviously, March traded greater than 1276.90. Fast forward to 111. At this point on the 11th, the trade was upside down about $58. At the high water mark, this trade would have been upside down somewhere around $90 a thousand. So when March went to 1338, the net effect would be, just based upon the implied volatility and the calls getting blown out, calls were super expensive. This trade would have been upside down by $90 a thousand. Fast forward to today, and these are theoretical values. That put now is back in the 63.80 area. The call is worth $9, so it's in the money now by $80. But you can see basically the call has collapsed in value. It's given everything back. The put is gradually starting to gain, and if I hold this put, anything under 950 would function dollar for dollar. So there's not much potential left in the call. So I probably would begin to cover this call, take the money out of the call option, and probably just stay long the put. So I just wanted to update this. This was that hedge example, and just how it played out, over the last month or so.
Right. And
And for next week, I can develop a strategy where potentially you're buying that call, selling the put, whether it's in March or May, but another way to get long where you're going to collect money, and it might not be at the market, it might be out of, it might be underneath the market, but another way to get long this and getting paid to get long, so we can look at another strategy next week as well.
yeah, absolutely. I mean, this was a good hedge. Whoever would have put this trade on, in fact, it's probably even more than that with the limit down and showing that the implied
Yeah, yeah.
price right now. They, and talking about using options to get out of a position. I'm not sure where you could actually buy puts at today. There's none offered. So, um, unfortunately, if you're in a long position right now, it's a tough squeeze. We're definitely in the long liquidation mode and getting squeezed.
Yeah, if you look at the serial options February, which go off in 6 days, the February 1055 puts, I'm sorry, not 1050, the 1050 puts traded in a $20 to $25 range. And then the 1040 puts, these are February 1040 puts traded in it looks like a $15.60 to $22 range. So, that's, if you bought the puts, you can exercise the puts against a long position and be short against a long position. You're going to pay for it. Obviously there's a premium attached, but it's one of those unfortunate things where right now this is a very illiquid market, and I think once you flush out the margin call type longs, then it's not going to surprise me. And you might have to go to a more extreme level, that 1,972, 950 area. But once you do that, it's not going to surprise me to see a big bounce back once the longs are out of the way here.
Yeah, there's absolutely no one's helping them out right now. That's for sure.
Yeah, no, no.
All right, well we'll see next Tuesday. I think the commitment of traders report will reflect the position as of today.
Yep.
So it'll be very interesting to look at. And where can they find the commitment of traders report? It's on the CFTC's
Yeah,
website.
if you go to the CFTC website, you'll see a tab for commitment of traders, and it's right there. It's all publicly, it's all publicly available for public consumption. If you have any questions on where to find it, shoot me an email, shoot Mike an email. I'll be more than happy to provide that link. This is all public information, and anybody that's trading, you should look at. I'm sorry, I don't know where you went. Hang on one second here.
Yeah, it is. That's the nice thing. The CFTC puts it out. It's you can see it for free, cftc.gov, and go to the CME website for all of the open interest information.
Mike, the one thing I just wanted to, can you, am I still, am I still sharing the screen by chance?
You are.
Okay. So I don't know if you could see, this is, and thanks to Alex at Stone for putting this together. This is a lumber histogram over the last 1 year. And you can see, 22% of the days, 950 to 1200, 25% of the days now 750 to 950. You can see, and the next one is a 2-year, but you can see how gradually this number is shrinking. These numbers are getting larger as lumber evolves into something new. What pricing ultimately is meant to be, is yet to be determined. But we know that the old days of $300 to $400 lumber are behind us, and what we're evolving to, we're just going to have to get more and more accustomed to extreme volatility at these higher end numbers.
Yep, perfect. All right, Greg, thanks. We'll catch everybody next Tuesday.
I appreciate it, Mike. Thanks a lot.
All right, have a good week, everyone. Be safe.